So if you're interested in scaling your real estate business, going from a handful of properties up to say 2,000 units, if that's what you're interested in, pay attention to this upcoming episode. Let's go. Hey everybody, how you doing? Russell Westcott here. So hope you're having yourself a wonderful day. In this upcoming podcast video episode you're about to watch, I had the great opportunity of sitting down with a very good friend, Mr. Thomas Beyer. And I had the opportunity to go on one-on-one for more than 2 hours to sit down with Thomas in his beautiful penthouse apartment overlooking the UBC endowment grounds. So if you're interested in scaling a large portfolio, this is the episode for you. In this episode, we talk in depth about what it takes to build a team, grow a business, raise the capital, and we went very deep into the realm of raising capital from the public. So if you've ever wanted to raise capital outside of family and friends, pay attention to this upcoming episode. Two of the biggest lessons you will take away from this episode is be known for something. When somebody thinks about you in the realm of real estate investing, are you known as an expert in something? And the other big key takeaway is treating your real estate like a business. All right, with all that being said, let's get after it. All right, welcome back, everybody. Russell Westcott here. I've been looking forward to this interview for a long time, and I'm not gonna, I'll cut in an intro before this, but I just want to get right to it. We have so much to talk about. Ladies and gentlemen, I want to introduce you to my good friend, Thomas Beyer. Thomas, how are you?
Hi, Russell. Thank you for meeting me.
So, Thomas, we're having a fireside chat here, if you will, without the fire, because it's summer. Right. And first of all, Thomas, thank you for taking me on an unbelievable tour of your place here. So for everyone, if you're watching, we're in the University of BC, UBC campus, right on campus. And this is a fantastic penthouse that we're in. And maybe I'll get some shots here for everyone. But so Thomas says, has real estate been able to buy this place for you? Or is it just your good looks and all your talent?
Yes, real estate, we actually ended up selling in 2007 into the boom, which was, over 10 years ago. We sold about half the assets in Alberta. And specifically, we had bought a building in 2015 for about $42,000 a door for about $4.5 million. And we sold for $9.9 million about 2.5 years later.
So that's good.
That's very good. And I happened to be a 30%. I mean, that was one of our first syndications on a larger scale, but I was a 30% owner of the profits. So that enabled us to put an offer on this condo. We ended up buying it in 2009.
Nice.
So almost 9 years ago now.
Now, it's funny, I sent over the agenda and all the questions I wanted to talk to Thomas and the intention map and all these wonderful things. Thomas sent back, goes, just as an FYI, we are spending 3 days together. so we have a lot to go over. And but first of all, I think there's unfortunately, there's a lot of people that don't know who Thomas Beyer is. Mm. You're not retired, but you've started downsizing a little bit with many of your projects and things like that. So for people that want to know who Thomas Beyer is, maybe just give us the quick Coles notes. That accent isn't Albertan, I understand.
It's Southern Alberta, actually.
Southern Alberta, yeah.
Canmore and Calgary. So you mentioned retirement. I mean, retired and retarded is sometimes closely related. And so to me, retired is more of a financial state. And I'm more like a shark. And I mean, if you know what sharks, if they stop swimming, they die.
Right.
So I think I will always do some deals for the rest of my life. But the question is really one of intensity and maybe dollar volume and how many partners you engage. And I'm in my late 50s now, so I'm not as energetic as I maybe used to be when I was Russell's young age or in my 30s.
I'm almost there too.
So my 30s and my 40s was sort of the boom, buy real estate as much as you can, as levered as you can, and grow the asset base and grow the net worth. Mm-hmm. And now I have a substantial net worth, and I'm trying to protect it and monetize it, right? And we have obviously...
You're optimization, harvesting, and any opportunities, you still are taking opportunities on all the time. And you showed me in your office, and maybe we'll do a quick tour through there and show some of the projects you're working on right now.
Well, I've been in real estate for about 20 years because I'm a software engineer by training. I came from Europe, specifically Germany, to Canada in 86 as an immigrant with a very sick accent, yeah. Of course, I'm sad that the German team just got kicked out of the FIFA World Cup in Russia.
Yes, and we're going to date that by saying that. That's all good.
And I was running software project on a large scale. I was in software marketing, but my first job actually was in Burnaby, here just close to Vancouver in 88 to 1990. And the same headlines you've seen the last few years in Vancouver about real estate boom and who can afford it, it's really expensive and prices are inflated. Those same headlines were in the newspaper 30 years ago in the late 80s. Right?
It's almost like they recycled the headlines.
And the light bulb really went on when I talked to one of my colleagues in the software development and just chatting at the fires at the cooler. And he said, "What are you doing?" And she said, "Oh, I own about 10 houses." She was of Asian descent. I said, "Oh, you own 10 houses in Burnaby. Oh, interesting." And I knew that year, because of all the money coming from Hong Kong in the late 80s, those prices in Burnaby went up about $100,000 a unit, from about $150 to $250 for an average bungalow in Burnaby. Mm-hmm. And so, being quick with math, I realized, wow, she made $1 million this year just in net worth improvement by having owning these 10 bungalows, which went from $150 to $250 on average. So she made $1 million this year. So what does she know that I do not? Right? So that was in about 88, 89. And again, same headlines. 250, can you imagine? I mean, completely unsustainable. Who can afford a bungalow in Burnaby for 250? Must come down, average price to wage ratio, blah, blah, blah. Same headlines as today. And of course, that bungalow today in Burnaby is probably 1.2 to 1.5 million, right? Wow. And it's going to be 2 million in probably, maybe, by the 2020s. So that's when light bulb went on. We ended up moving back to Germany for about 2.5 years, had kids, and, life goes on and career, and yet didn't have time to pick up that initial light bulb of, I got to do something in real estate. But when I actually walked through Munich, where I had studied, all of a sudden I realized there's all these buildings in Munich, like in any city. Right? You walk through the street, there's buildings everywhere. So I wondered, who owns these buildings? I mean, it never occurred to me ever in my life that any building you walk, in any city is owned by someone. It's either the government, or it's some club, or it's usually individuals or groups or sometimes pension funds. But all of a sudden, you're actually aware of what's out there. And there's an office building. Oh, someone owns that. What are the numbers? What's an average rent here? Oh, there's a nice bungalow. What's that worth? Oh, there's a condo on the 5th floor. What's that worth? I mean, I'd never even thought about that until my probably early 30s, right? It was just buildings are there, houses are there. So that didn't even occur to me. So all of a sudden you're aware, right? So once you have awareness, then you can also fill that with knowledge, right? So I took a course with Raymond Aron, many of you might know, in Toronto.
Raymond's still around? They were kicking around every month.
And he had a course, $99. I teach you how to become a millionaire. And really said, I said, yeah, right, whatever. But two-day weekend course, $99. Hey, what can I lose,
Hey, Raymond, if you're still doing real estate, here's a testimonial for you. For somebody who bought your $99 course.
And I ended up writing a book about it. Actually, one of the quotes and people I thank in the book is actually Raymond Aron. And I should actually send you that book and maybe you do lunch at some point. But so that also kickstarted more knowledge. Mm-hmm. And I didn't do anything until we actually moved to Calgary in the 90s, mid-90s. And then I ended up buying a condo, hence the book title, 80 lessons learned from 80,000 to 80 million, because my first condo was $80,000. Right. Yeah, about 95, let me say, right? It's 23 years ago now.
And do you still own that place? Or?
That I didn't. I do not. I sold it for about 140, 150. Right. But about a year later, I bought a condo in Edmonton for about $80,000. That I still own today, 20 years later. And went through the booms and busts.
And then you branched out into different things. You had a property management company. You were acquiring like crazy. I remember every RAIN meeting I was going to, they had things called infomercials would come up there, and Thomas would get up there, and your tagline was, "Hi, I'm Thomas. I'm a buyer." No,
I'm Thomas Beyer.
I'm Thomas Beyer, rarely a seller. Right? So it was quite catchy.
Because the idea is you have to acquire real estate, right? Yes. I mean, knowledge obviously helps, right? And what Russell does here, groups like RAIN or Aussie Jerk. I mean, these are all good groups to join, obviously, and knowledge in books. There's many authors. Don Campbell. I mean, many authors have written valuable books. That's all very good stuff. You want to obviously learn and take in this knowledge, but you got to act at some point. At some point, you got to jump in the water if you want to learn to swim and get wet. And maybe you drown a bit and get wet and you get water in your mouth and your ears, but you usually don't drown in the first attempt. And you can, continue your learning as you do stuff. So you buy a condo, you buy a house, and maybe you pay too much for it. But hey, you learn something, and next time you will be better.
And as time went on, you branched out into multifamily, different. At the peak of your, not empire, because your empire is growing all the time. At the peak of your acquisition phase of owning, what were you? What assets under management do you think number you had, and what number of units would that be?
Well, the peak was probably about 5-6 years ago, about $125 million.
$125 million
of assets under management. It included one very large asset near Dallas in the US for 300 units, which we bought for $13 million in 2007 and almost lost it in the 08-09 recession with 30% vacancies and massive cash injections required for repairs. And we sailed through, but it was really, really tight. And we ended up selling it about a year and a half ago for $25 million.
So what did you buy it for again? Sorry?
13.2 million.
And essentially you doubled it.
Well, not quite.
Almost.
But of course, as a mortgage, we had a $10 million mortgage. What actually happened in this building specifically, we bought in September of 2007. And like we
when was Lehman Brothers? Was right after that, wasn't it?
Well, exactly, because usually when we buy older buildings which have lots of rental upside and renovation requirements, you usually get a short-term mortgage, maybe a 1 or 2 year mortgage. You fix the building up, then you refinance with higher values, right? That's a very good value add and wealth creation strategy. We were thinking about that and almost got a 1 year mortgage, do the renovations and refinance in September of 2008. And that was the month when Lehman Brothers and AIG collapsed, and the credit market in the US was frozen completely for about 6 months until about February, March 2019. We probably would have lost the building then. Right. We didn't know that, of course, in September of 2017. We ended up locking in a 10-year mortgage at 7%. I think it was 6.9, and we had a small second mortgage at 13%, but the blended rate was like 7.1% for 10 years, with very tight cash flow, I can imagine, for the first few years until maybe 2010. And then finally, it really improved really nicely until we end up selling into a big boom.
Well, and I imagine also getting into 30% vacancies and things like that too. It was probably cash flow was non-existent for a while.
Absolutely.
Right,
correct.
until you fixed it, normalizing it. And we make the joke about if I had some hair that I let grow too, we'd have very similar hair color. What's the joke that I saw you use on stage about your hair color?
Oh yeah, I do color my hair. It's called Wisdom by L'Oreal.
Yeah, Wisdom by L'Oreal. So 125 million in assets under management now.
At the peak today we're probably down to maybe 75 because we ended up selling, and I mean, I ended up moving specifically to apartment buildings because after I bought the third condo, on all of them around $80,000, I realized, wow. I think apartment buildings or condos are priced like flour. If you and I buy a pound of flour, we pay a certain price. But if you're a baker, you buy a 30-pound sack, you pay a lot less per pound. But you and I don't need 30 pounds, right? Yeah. We need 1 or 2 pounds. So we buy smaller quantities and we pay a lot more per pound, probably double, right? But a baker buys a whole sack, 30 pounds, 50 pounds, 100 pounds. And of course, he pays a lot less per pound. It's the same flour. Yeah. Same is true for apartment buildings. So at the time when I bought these condos for around 80,000 in the late 90s, an apartment building in Edmonton was around mid-30s to mid-40s a door, similar. And I ended up buying a 15-suiter in 2000 and then a 24-suiter and a 20-suiter about 2 years later. And that was with my own money, and then I added partners after the third building. Yes,
that was actually the line of question I was going to get into. Now, obviously, in order to get to $125 million in assets under management, you didn't have all that money in your bank account.
No, I did not. In fact, I came to Canada with less than $1,000 in my jeans, and I didn't know a soul. And so you accomplished quite a bit over the last 20, 30 years.
And now there's probably still only $1,000 in your jeans. It's owned by other assets, and it's protected under veils.
But it's also called cash is trash, right? I mean, we are in an inflationary environment, and so forth. You want to have some cash, obviously, as reserves, right? But I still like the idea of borrowing money at today maybe 3.5%. And if you invest that at more than 3.5%, hopefully 5 or 6 or 7, which is called a cap rate in buildings, you usually come out okay, right?
So you had to learn the art and the science of raising capital, in essence, in order to get $125 million at its peak under there, and you did not have all the assets. You probably still sold one or refinanced and things like that, but you had to actually go to other people to raise capital.
Absolutely.
Right?
And it's very common, right? I mean, many, especially larger buildings, office buildings, whatever, shopping centers, are usually owned by groups. There's usually more than one guy behind. It might be a family, might be two brothers, might be 10 dentists, right? That's very common, actually.
So what, in your ballpark number, I'm not looking for the exact dollar, but you may have it, I know how detailed you are, what would be your best estimation of the capital you and your companies have raised over the years?
You probably raised about $45 million.
About $45 million. So
over maybe a 10, 12-year period.
Right. So suffice it to say, you know a few things about how to raise capital from other people.
Absolutely.
Right? And that's why we're here talking with Thomas Beyer, is because he's just such a wealth of knowledge on this. So, but you said you had to start somewhere. Did you start with family? Did you start with who was the first?
No, as I said, I mean, the first was that condo. I mean, we before that we ended up owning a house in Toronto, where we lived for 3 years. I was working at IBM in Toronto before we moved to Calgary, and we owned a house there. We actually lost money in the house in Toronto. I think we paid $230 and sold for like $200. And then we bought a similar house for $200 in Calgary, and we ended up selling that, I'm not sure actually, higher, but not a lot higher. Then we moved to Canmore, lived there for almost 10 years, and that, we built a house, and then that really went up in value substantially. But that was not per se an investment property. But I still believe, and there's a chapter in my book about that you ought to own the biggest house you can afford. And that, of course, depends highly on your income, right? Some people can afford a one-person studio, and some people can afford a 10-bedroom acreage, right? It's really, that's an individual statement. But on average, if you live in any urban environment today in North America or Europe, or even in Africa or Asia, with immigration and with population growth, it's a fairly good assumption that prices will be higher 10 years from now, 20 years from now. I mean, we don't know how much higher, but you go to Egypt, you go to Munich, you go to Vienna, you go to South Carolina, you go to Mexico City, it doesn't matter. Prices today will be higher than they were 10 years ago, or 20 years ago, 30 years ago.
And it's just the law of inflation, really.
So if you own a house today for $1 million, let's say, and that's on average, let's say in Calgary, a nicer house than a house for $500,000. So if you can afford a house for $1 million, then buy that, because in 20 years that's going to be worth, let's say, $2 million, versus the $500,000 house will be also double, will be worth $1 million. So in one house you made $1 million, in the other house you made $500,000. So I still think it makes sense to buy the biggest house you can afford, keeping in mind you got to pay your mortgage usually. There's no income, so you to multiply and to want to buy more buildings or more houses than your own personal residence, you got to have cash flow, obviously. You don't get rich on the cash flow, but that's what is required to pay your bills every month.
Well, makes sense. So when you first stepped out into capital outside of your own resources, was that within the family? Was it in close acquaintances? Who was the first, what you would consider the first time you ever raised capital from somebody outside?
You start usually with people you know. And you start with people who have some money, obviously, right? So one thing is that you got to talk to the person who actually can write a check. That might be your aunt, it might be your uncle, it might be your father, it might be your rich brother, it might be your grandmother, it might be your golf buddy, right? And so, I talked to my dad, and then eventually I talked to some friends I knew, and today, I mean, the technical term is close business associates, but people you know in your network, people you've worked, maybe went to school with, people you from your bowling club or from your church or from your golf club, right? People you hang out that they know you and they trust you and say, hey, here's 100,000 or here's 50,000 or whatever you need for that acquisition. So I ended up buying these 3 condos. I sold one, and I ended up buying 3 of the buildings with my own cash, a bit of cash from my dad. And then I sold the first building and doubled my money. And all of a sudden you have a story to tell, right? Because any person who has money wants to know how to invest it. In fact, when I started, I got $100,000 extra from my software career, and I had no clue what you do with $100,000 except spend it and buy me a new car. But no one teaches you how to invest money unless you specifically actually go out there and learn it. But all of a sudden I got 100,000 extra. So, well, what do I do with that? And then I started looking into how to buy multifamily and go to Edmonton, talk to realtors and property managers, and end up buying a building with 15 units with 100,000 cash, roughly $570,000 mortgage, or $500,000 mortgage roughly, with fees and stuff. It was about $37,000-38,000 a door. I drive by this building frequently, 9910 156th Street in Edmonton. It looks exactly the same today, 20 years later, right? It still looks ugly. It still looks weeds growing, But guess what? That building I bought for $37 a door and sold for $50 a door. I doubled my money. Today it's probably worth about $110 a door, right? I should have kept that building. Yeah. Would have been a millionaire just on that one building.
Well, but at the same time, you were doing things for a couple of reasons. Number one was you were building a track record that you could tell to other people because you knew the route to go was to raise capital from other people. And you needed to have a track record in order to show that to other people. Right. The other thing you were doing was you were learning and you were going through the process. You went through the process of buying, you went through the process of owning, you went through the process of selling.
Correct.
So you did it all.
Correct.
So then you could tell somebody, when you're looking at somebody and you're trying to raise $100,000 from somebody, I have personal experience of buying, holding, and selling, and here are my results in black and white. Exactly. Would you like to participate with me?
And that's a very powerful story, right? And so you have to become an expert, at least not a true expert, but at least an expertise beyond the average human in a location, let's say Edmonton or Calgary or wherever you think there is actually upside, Saskatoon, whatever it is. And a certain property type, because you can't be a specialist in Saskatoon and in Regina and in PEI and in Halifax and in Edmonton and in office buildings and in property and apartment buildings and in mobile home parks and in duplexes and in shopping centers. You cannot, right? You got to focus and say, okay, I want to be an expert in my case, smaller apartment buildings in Edmonton. That's where I started.
And the tighter the niche, the tighter the specialty, the tighter that people will be attracted to you, and the better your results because you're focusing on it. You become one of the best at it.
Yeah, and you did, in your case, you did a lot of townhouses also in Edmonton, right? And after a while, whether 220, let's say, for a townhouse, is that a good deal or is that overpriced? After a while, I wouldn't know that because I'm not a townhouse specialist in Edmonton. But you would know that because you go there and say, 225, that's a good price, it's a really good deal, because the average is at 245, 250. Yeah. But the average guy wouldn't know that. It needs a lot of experience to say, this is a really good deal, you got to put on a contract fast.
And right? I can very confidently say, one of the best things I do know is which townhouses not to buy.
well, of course. I mean, part of winning, in fact, part of selling is actually, because I spent 3 years in sales at IBM. Part of selling or part of attracting joint venture partners is also learning where not to go or to disengage quickly, because some people just waste your time and you go there for lunch and dinner, have meetings and send them brochures and send them performers and spend time on the phone and they will never invest with you, right? Yeah. So you got to learn also to cut the cord quickly and differentiate between, this guy is really serious and it's worth the extra 10 hours of follow-up. And the other 3 guys, I put them on my list and send them emails perhaps, but that's it.
Nice. Okay.
So I think time is relevant because time is actually limited, right? You had only 24 hours a day.
Nice. Well, we're here with Thomas Beyer, and we're actually just getting warmed up. We have some more segments here. I'm just going to do a real quick reset of the cameras, and we're going to dive head first into raising of capital. Once you start exhausting your family and friends, what do you do once you have to go outside of that group? And we're going to we're going to put our water wings on, and we're going to dive into the deep end of the pool. So if you're watching this video, I would categorize this one as an advanced. As someone who, we're going to get advanced. So if you're just starting, don't be paranoid, don't freak out. This is something to aspire to, and there's just some gold nuggets that we're going to have for everyone. So we'll be right back. All right, everybody, welcome back. Russell Westcott here with my good friend Thomas Beyer. 80 lessons learned, Thomas. So 80 lessons was like 1 week worth of lessons. Is that it's like 80 lessons every year almost, right? So what was the process of writing the book?
It's just a catchy title because at the time I wrote the book, which was maybe, 7 years ago or something, we were at about 80 million in assets. Yeah. And in fact, the first condo I bought, as I mentioned, was $80,000, right? So that's, it's the road from 80,000 to 80 million. And then 80 lessons, we
need to have the 8th anniversary edition.
Perhaps,
next year. So we in our first segment, we had a conversation. Thomas told a lot about how we got started, and we're now in the part of the process where you're raising capital from other people. You said something once to me when we were on a panel that absolutely just resonated to my core, and it's a conversation that a lot of people are asking themselves right now. Is how do I'm asking somebody for money? It almost feels like, not that I'm begging for money or things like that. It's a lot of people have that fear of that money conversation with somebody, or that we're asking them for money. And you said something very succinctly, and you said, I never ask for anything from anybody. I actually offer an opportunity for someone to participate in something I'm doing.
Exactly.
And when I heard that, I just said, yeah, that's actually really what it is. Maybe if you could, build upon that. And how did you come to that realization? Was it some deep inner work, or was it just by doing it lots?
Well, as I mentioned earlier, I mean, if people who have money, and there's people, as you know, with substantial wealth, millions of dollars sometimes, they need to always look for how to invest their money, right? Mm-hmm. And many give it to the financial advisor, and then they invest it usually in stocks and bonds, and they get a certain return. But some people are not so happy with the returns, and they take a big fee. And they want to do a bit more direct investing. So they're usually looking for what is out there. And they go to Michael Campbell's money talks, and then there's conferences in Toronto and in the US. And so people are always looking, where can I place my money, right? And so if you come across as a guy who has an opportunity, because you may be a townhouse specialist in Edmonton, and you buy these townhouses for $220 a door, and you need 70, 80,000 cash down and a mortgage, and then they're going to be worth eventually 250, 280 after a few years. That's a story worth telling, mm-hmm. right? And you might even decide, look, I invest some of my own money. I need $80,000 cash. Maybe I put in 20 grand myself, but I need 60. Yeah. And you just tell that to people and tell them what you're doing. It's more like a natural conversation. Yeah. And some guys will say, you know what, I could care less what you do, because I just want to play golf. Okay, fine. And you zip it and play golf, yeah. right? But if the guy has an interest, that's interesting, tell me more about it. Well, then you tell him more about it, right?
Yeah, and sometimes we make the incorrect assumption that we think that people with high net worth individuals are experts at where to invest money. And the reason why they are high net worth is because they know what they're doing. A lot of them are just looking for guidance. Yeah. Right?
Well, in fact, some of the worst investors are often doctors and dentists, because they are very smart usually. They have a very good education, mm-hmm. and they're expert in their field, mm-hmm. And people cater to them and say, oh, Mr. Doctor, and try to convince them. But they're often very busy. They don't have the time. If you run a busy dentist practice, you're tired at the end of the evening. You don't want to now spend hours and hours looking for multifamily deals in Edmonton, right? So, but some do, and then they get duped and they pay too much, and because they're so smart or they're so good in their profession, doesn't mean they're also good in another profession. They could be that good, but it takes substantial time, right? I mean, it takes time to build an expertise in shopping centers in Calgary, mm-hmm. right? And some people, that's the expertise, and they know everything about every shopping center in Calgary. That's what they do. Right. But they're not experts in townhouses in Edmonton, because they focus on shopping centers in Calgary.
So have you ever had the fear of having a money conversation with somebody? Did you have that fear, or how did you get past that? Or was it just something that you just felt confident in what you're doing? How did you... Take us back when you were just branching out into that. You maybe only had one or two places. Did you have a little bit of fear around raising capital from others?
I'm generally fearless. That's probably one of my attributes. I do skydive, and actually, if I weren't married, I'd do wingsuits. And motorcycles.
Like the Batman type of thing. Yeah, okay.
There's an abbreviation for fear, which is false evidence appearing real. So the question really is, if you're fearful, like what are you fearful of actually? And the fear is often the guy says no, right. And that's to be expected. So I spent 3 years at IBM in sales, and you phone someone. In this case, I was selling software. You will always get no's. So and it's almost a ratio. I do 10 sales calls, I get 8 no's. Mm-hmm. It's just expected, but I get 2 yeses. Or maybe 1 yes and 1 maybe. Yeah. And then you meet the guy, and out of it, and the maybes, your job is to turn into yes eventually. And many no's, in fact, are not yet. Yeah. So I've had many conversations with investors over the years who read my book, or who came to trade shows or followed certain seminars we did, or video conferences. And for 5 years, they wouldn't invest. And then they come to me 5 years later and say, "Oh, can we still invest in that apartment building in Dallas?" I said, "No, that we raised money 5 years ago, but we got this another deal here. It happens to be in Vancouver Island, perhaps, right?" So some people are not yet ready, or they need to see maybe what we've been doing. So you told them about this townhouse for 220, and they sort of believe the story, but they're not quite ready.
But they want to see you. They want to see you get a little more experience in what you're doing.
Yeah, or they just want to see more evidence, and then you go back to them a year later, say, "Look, as I told you last year, we bought the house for 220 with another group or another person. Here's my new appraisal. Now it's worth 235." Okay, and the guy says, "Okay, that seems kind of slim." Okay, and then you go back a year later and say, "No, here's the next appraisal. It's 245." And after 3 years, maybe it's now worth 250. They will say, "Okay, now I want to buy one with you." Right? So some people just take time. It's just very normal. Some people are much more cautious than others. And you cannot expect that after one conversation at a golf club or the church or at some bar that they pull out the checkbook. It's completely unrealistic, right?
So if you really think about it, and the one thing I love about Thomas, and if you do read his book, I highly recommend to read. If you do read it, it's almost black and white. It's to the point. It's pragmatic. It's a mathematical formula almost. It's like and I'm not saying it's the exact numbers, but your ratios are pretty spot on. If you talk to enough people, you will eventually get lots of maybes. You'll get not yets, but I want to keep watching, and you will get some yeses.
So what I did in the beginning, because as I mentioned, I started with my own money, but after about 2-3 years, I was telling the story. Hey, I bought this building for $37 a door. I sold it for $50 a door. I doubled my money, turned 100 into 200. And people say, "Oh, it's interesting. Tell me more about it," right? And then you tell them more about it, and they say, "Okay, so interesting. If the next deal, give me a call." Okay, so now you write down their name and phone number and an email, and you build a list basically. And that in the beginning was a spreadsheet, right? And over time it grows. You put some notes down, depending on how thorough you are. And you just blast an email out every 3 months and say, "Hey, we bought another building. Hey, here's what's happening in the economy. Here's what's happening in politics or interest rates." Just keep in touch, right? And by the way, we're looking for money right now for our next townhouse project. And eventually you send that email to enough people. Over time, people will come back to you and say, "Hey, tell me more about it." And then you can send them maybe a little pro forma and says, "Here's the specifics on this one building. I'm raising $200,000. I need 10 people with 20,000 each, or two guys with 100,000, whatever the story is." And you now tell that story in a comprehensive manner. I mean, I find it always amazing because I'm a member of RAIN, and I also invest money now with other people. And people come to me and say, "Hey, I got this deal here. Do you want to invest money?" I said, "Sure, maybe. Tell me more about it." And it's atrocious what some people send you. Like they send you like a link to an
MLS listing.
The MLS listing, or they send you an email with 5 words in it and spelling mistakes. They're like, come on, man. If you go buy a car for $20,000, you get a fancy brochure with 10 pages and colors. And, I don't expect you to produce that glossy, but tell me, what's your name actually? What's your phone number? What's your email address? Like who are you actually? Give me a little bio about yourself. Mini bio, not the whole life story, but like, what are you? Are you a software engineer? Are you a painter? Are you a stay-at-home father? What are you? And then tell me more about this specific deal. Why do you think this deal is a good deal? Why is 220 a good deal? I don't know. I'm not the townhouse expert. Just tell me. And they say, "Yeah, look, all these other ones in the area have sold for 230 and 240, and I'm having on a contract for 220. And here's what I think the projection will be for the next 5-6 years. And here's why I think Edmonton is a good city to invest. And give me a little 3 or 4 page document. And then I can at least have an interest. And then I can ask questions. So why do you think it's going to be going from 220 to 250? Then we can have a conversation, right?
Wow. I hope you guys are paying attention. Thomas just gave you a master class of putting a presentation together. And there's a big meme and a thing going around on the internet is, perfection's the enemy of progress. I understand that if you're stuck, you want to do something, get it out, but it doesn't give you a pass for putting out crap. Right? It doesn't give you a pass. Steve Jobs, when he was going there, he would roll over if his companies put out. They did the best they could at what they had at that time, and then they kept slowly evolving at the time. So it doesn't give you a pass for putting out junk. right?
And you put your best foot forward, right? Yes. And then you improve, because once you put a pro forma out once, and you get feedback. You get feedback, and 15 guys ask the same question. Well, maybe I should address that in the next pro forma, because they asked the same question, such as, let's say, interest rate. Maybe I didn't talk about interest rates because they're very concerned. Oh, interest rates might go up. Now it's 3%, might go to 8%. And my mother, she paid 18% interest. And this is a common fear by some investors. And maybe you have a blurb about why you think interest rates will stay moderately low. They might go up 0.5%, maybe 1%. No big deal, right? They will not go to 18%. Maybe you want to have a little blurb on that, because people often get hung up on one issue.
So really, okay. Holy moly, you said a lot there. I'm gonna just bookend it here a little bit. So everybody always wants to know, what's the secret sauce? What's the secret? What's your secret, Thomas? Really, I heard it's longevity. It's starting with having a conversation with people, putting names into a spreadsheet, following up with people, and constantly having an opportunity available, and slow and one step and every day taking another step forward. You kept building the spreadsheet. You kept building more people. You had more opportunities. Some people said yes. You built the track record, which you just built an upward spiral of just everything you were doing, and it was no secret. It was just daily putting on your boots and putting on the overalls and getting to work.
Well, I'd say boots are actually not required, because, as you know, usually you talk on the phone.
Yes.
and only occasionally do you actually go out and actually physically meet the person. You know, sometimes actually only once they hand you the check, right? So one skill certainly is telephone skills, which is one of my very weak points. I don't like to talk on the phone. Because I don't see your face. It's one of my fears, we're going to call it. You know, I rather send you 3 emails or 15 texts than picking up the phone, actually.
Okay.
But I know, I overcome this fear, and I know once you talk on the phone, I can build a relationship. But follow-up, for example, is one issue. I mean, I'm surprised you go to trade shows or you meet people at some conference and you talk about some stuff, and they tell you, I'm gonna follow up, I'm gonna send you something. And sometimes I ask, well, okay, when can I expect that? And they might say, okay, Wednesday next week, or within a week. Okay, fine. And probably 50 to 80% of the time, you hear nothing, right? So I think follow up. If you tell someone, I will get back to you, get back to them. It's really that simple. And it could be as simple as, I told you I'm going to get back to you in a week. Look, something came up. I really can't. I need another month. Just a quick email or text message. People say, sure, no problem. But you get back to the person. I thought about you because I told you I'm going to get back within a week. But look, I just couldn't finish it. I was so much stuff going on. But I'll get back to you in 1 month. And then within 1 month, you get back to them and say, as I told you a month ago, here's what and then you can do a conversation about that again, right?
Now, and so most people don't even follow up the first time. Exactly. Where you just said very, very clearly was the majority of your investors came from follow-ups months and even years after the fact. So it's on the consistency of the follow-up and the consistency of the communication and the consistency of being in deals.
Right. And of course it helps if you're in an up market. I mean, we had now 3 years of a down market in Alberta. I mean, money raising was certainly a lot more difficult in Alberta, and we haven't done it, certainly. Although we did end up raising about $2 million last year from about 15 investors to buy 2 mobile home parks, because the market had just started turning last year in Alberta. And I think it's also important to be sincere, right? Yeah. Don't flatter people, don't give them all this BS about these exaggerated numbers, because the market is more muted today. Interest rates are on slightly rising, right? We have seen certain cooling measures here in the mortgage market the last few months. So I think real estate will not go up 4, 5, 6, 8% a year, as we might have seen in the 90s or 2000s. I think we will not see that again. So be realistic with your numbers, right?
Yeah. What is your call right now, give or take? So
that's average. Yeah. Probably inflation, 2%.
2-3%.
Not even 3%. I mean, again, if you buy this 240 townhouse for 220, well, there's a room right there, right? Yes. But if you buy an average house, average condo, average building, you can force appreciation through improvements, right? But that costs you money, right? So let's say that 240 townhouse, if you put luxury upgrades in, maybe get 260, right? But then you can also over upgrade and spend way too much money on the kitchen and the bathrooms, and you spend $30,000 in upgrades to get $15,000 in value lift. That doesn't make sense, right? So there's always a fine balance of when is enough good enough, right? So I mean, in fact, my next book, if I ever write it, is called, or might be called, Forget Excellence. Good enough is good enough.
Yes.
Right? So people don't expect excellence, and it's preached a lot, obviously, but if you look at tennis or soccer, of course, you want to play FIFA worldwide, you got to be excellent. But most people don't end up being in a FIFA World Cup. Yes. Most people are not excellent. Just acknowledge that fact. And if you're good or even just above average, for example, in property management, you have to be, even if you're just average, you're already well ahead of the crowd.
Well, yeah,
it's unbelievable how sloppy service is provided by many property managers.
Most property managers out there right now call them accidental landlords. People, in some markets, people couldn't sell their house, so they go, well, I'll just rent it.
Right.
And they have no education, and they get a very, very rude awakening on
yeah, as I said, I mean, just actually getting back to the person, if you told them, I'm going to get back to you by Tuesday, that's already above average, right?
So over time, you built now you don't have to share the exact number, but what would you say number of people on your database of investors, give or take?
At the peak, we probably had 700 investors.
700. And that was truly...
No, sometimes it's, again, the question is what is an investor? Because we ended up also raising money through RSPs.
Yeah.
And then maybe it's a couple, but it's the husband invests. And
700 entities.
And the wife invested through her company perhaps, and the daughter invested through the RSP. Yeah. Is that now 3 investors, or is that actually 1? Because you screw one person, the other 2 will leave as well, right? We probably had, let's say, 400 decision makers, 400 to 500. Yeah. But sometimes they have to say, here's 20,000 in cash and here's 50,000 in RSP. Okay. Because it's actually a bit easier to access RSP money because it's more patient capital, right? Not a lot of people have hundreds of $1,000s cash lying around. Okay. There's people, of course, but there's not a lot.
So, but here's the power, and here's one of the lessons to learn is take the time to build the list, because you just mentioned last year you raised $2 million through 15 people. Yes. I'm going to ask you the question, but I think I know the answer. Did you, and I'm going to say the answer, this is my guess is, did you just go to your database of investors to get those 15 people?
Yes.
Yeah, they were all there. Right. You didn't have to go out. You didn't have to spend any more money. You didn't have to hit the pavement. You didn't have to go to any more trade shows. You didn't have to do any of that kind of stuff. You needed $2 million, and it was built in because you took the time to build a list.
Yeah, and we were culling the list a bit because sometimes people move, people get pissed off, and they say, you know what, I'm never investing with you again because you told me 15% return and it wasn't only 8.
It was only 12.7. Yeah.
You know, no, but again, we did end up losing some money on deals in 2014 to 2017. Not every person now is up, right? Because you bought in 2014, you buy leveraged. People have lost money until we, hopefully can recover that. So some people will leave you, and that's just to be expected, right? And people find other opportunities elsewhere and say, maybe multifamily is done. I want to do office towers. I want to do in the US. I want to do land development. Fine. That's just normal. It's always total normal turnover. And in this case, in a multifamily deal, we said you have to be accredited and you have to invest at least $100,000.
Right.
So immediately you know that out of, let's say, the email which goes to 2,000 people, really maybe only 150, maybe 200 are actually qualified for that, right? But, and I think, again, it's really important to narrow the funnel because you cannot talk to 2,000 people or even 200 people, right? But I can talk to 20 people in a week. I can do that. Even I can do that with my poor phone skills, right? And I mean, I brought in a partner, Scotty, about 10 years ago, and he just excels at telephone marketing, and he blows through 20 people in an hour. Again, that's a skill set. Some people just are natural salesperson, and they can follow up. But again, I think if you send this email and perhaps these 50 people are probably good candidates, just phone them and say, hey, John, I just sent you an email yesterday. Just want to know if that's a good fit or not. Click. That takes you 20 seconds as a voicemail. And then John says, Thomas, I will not deal with you again. Or he says, oh yeah, the email. Oh yeah, I got lost. I was busy. I was traveling. Let me look for the email. Okay. Or he said, he phones back and says, yeah, Thomas, sounds like a good idea, right? And I don't know where John is in his current life because I don't have a good relationship with John. I met him maybe 2 years ago at some trade show, right? But if I send this email to John and maybe phone him up over a course of 2-3 years, eventually John will say, yeah, that sounds like a good deal. I might invest in that one. Right? It's the consistency, because John today might not be able to write a check, but maybe in a year he is, because he just bought a new car, or he just bought a dental practice and is super leveraged, but maybe in a year he's better. Right? I don't know that.
Follow-up, consistency, and being a PhD. And I say PhD stands for pig-headed determination. So
determination, does help. You don't want to be obviously desperate.
Yeah.
And as I said, that's why the idea of co-invest with me is actually very powerful.
Yeah.
Especially if you put money in a deal as well, or if you tell them, look, I need to raise $2 million. We already raised 1.7. We're $300,000 short. And we have only 3 slots left. Some people then have this kind of FOMO, fear of missing out. Right, and they need to see other people invest first. They will never be the first one, right? Some people always like to be the first, get better terms.
Yeah.
We've done that. If you invest early because it's highest risk, or you write checks over a bigger amount, you get special terms.
Yeah.
So once you raise money on a larger scale, you need often offering memorandums, or certainly limited partnership agreements, which are more sophisticated documents.
Yeah.
But those terms can be spelled out in those agreements. Mm-hmm. And the first guy who writes a check has the highest risk, right? And because he might fund even some of your marketing.
Right. So really, you treat the raising of the capital like a business within the business.
Absolutely.
Right. You have a salesperson. You have a marketing budget against it. You have an entire follow-up campaign. You have a database. It's all those things. That's a business completely outside of the acquisitions of the assets.
Yes, but again, I didn't start there, right?
Yes, absolutely.
Because in the beginning, you are the
you and your spreadsheet.
Yeah, it's the Holy Trinity. Me, myself, and I.
Yes.
Because you phone, you send the emails, you produce a pro forma, you have the marketing campaign. But over time, you can delegate some of that. Maybe the pro forma, you have some numbers, but you give it to some graphic designer, and for $1,000, he makes it pretty, right? But there's enough tools out there now in Microsoft Word and all sorts of tools where you can beautify things at very low cost, right?
Well, you said we're going to just reset the cameras here one more time. Honestly, we're just getting started. And you said something. I want to run down the thread of, and we've talked a little bit about it. I've exhausted family and friends. I've exhausted that inner circle and the referral inner circle. I want us now to start taking the leap into the scary world, the public raisings of funds. Right. And guys, it is what it is. Don't shoot the messengers. We're just going to tell you the story. Some people will say, well, tell me what I need to do. And then we sit there and we'll tell you what you do. And they go, well, I don't like that answer. I go, well, it is what it is. Right? So,
exactly.
And we're going to dive headfirst into that conversation very shortly. So here with Thomas Beyer, everyone. Be right back. Oh, okay, and we're back. So we actually just had a little apple break, and we had some water, and we have our coffees. And Thomas, at the same time, you signed some documents to sell the property at the same time. So there's not a shortage of action going on around here, Thomas.
Right.
I wanted to go down now. I fully understand this is a very deep conversation, and it probably could be an entire topic of just this conversation in and of itself. But I want to paint the picture, and there's a lot of people that are following these interviews that are in the same boat. I've exhausted my inner circle, my family, my friends, their referrals, all the people. Everybody knows that I'm invested in real estate. They've talked to all their people. And, I've bought a 24 unit and a 48. I got 60 units. I want to take the next step now. I want to start doing some public raising of capital. Mm-hmm. What is some advice that you would give people in today's environment of raising capital from the public? What would you do if you were just starting to raise capital from the public in today's marketplace? What would be some of the steps you would take?
Well, first of all, I think you should need to assess, is that what you want to do?
Yes. Okay.
Because any asset you buy comes with a liability, right? There is certainly the mortgage, which is a liability, but you also take on responsibility to other people, right?
Other people who you don't know.
People you don't know. And you now also come under the realm of what's called securities. Mm-hmm. So there is, every province in this fine country has a security regulator.
Yeah.
And as soon as you syndicate a building, which means there's more than one person owning it, That could be shares, or it could be fractional units, or it could be limited partnership units, whatever the fraction is, or trust units. It's now called a security. And security is essentially an instrument, a legal instrument, where you don't know the outcome, right? I buy something at $100 a unit, and I hope it's going to be worth $200 a unit, but it might be worth $85 a unit.
Right.
I don't know that because I make certain assumptions about the world at large, right? So that is a liability per se, because now some stranger from the Alberta Security Commission or Ontario Security Commission or BC can phone you and say, hey, Mr. Westcott or Mr. Beyer, you see you raised $1.6 million here to buy this 60-plex. Mm-hmm. Tell me about it. Show me the documents. Yes. You had the investor sign. And that can get you in hot water if you don't do it properly.
Right.
So therefore you need to cover your assets, but also you got to have legal advice. Legal advice is not free, right? So you need subscription documents where you subscribe to a unit under certain terms, and accompanied with that is usually the agreement, which is often a limited partnership agreement, or it's a trust agreement, or it's a shareholder agreement. Mm-hmm. And that shareholder agreement is usually a lengthy, multi-page, 10, 12, 15, 500-page document, depending how detailed you want to be, which describes in fairly good detail what you're actually doing.
Right. So essentially, it's a big document of disclosures and risk acknowledgements, and it's basically a business plan on steroids, where you're sharing all the potential things that can go wrong. It's almost like a what can go wrong document.
Yeah, so for example, the document we used or have used has a 4-page section just on risks, which could go wrong: environmental risk and interest rate risk and market risk, and I could die, and fires, all sorts of stuff, earthquakes. You mentioned all that because all that could happen. Now, some things are very remote. Mm-hmm. Right? There's rarely any earthquakes in Alberta, but it could happen, right?
Yeah, there could be a tidal wave hit Alberta.
That's right. In addition, there's also restrictions of what you can say to people. So you should never guarantee anything. And even you got to be careful of any promises on returns, right? You can use the word target. So or anticipate. So we anticipate an 8% return. Potential 8% return. But even that, they can scrutinize and say, well, show me the evidence. And maybe you have actually a little pro forma and say, well, based on this assumption, I can produce an 8% return given my fees I have and my syndication structure and my marketing costs and my building prices over a 5-year period. Under this assumption, I can think an 8% is reasonable, right? You better have some document to cover that. In addition, not every person who wants to invest can invest. So there is what's called accreditation. Like, are you accredited? Mm-hmm. Or are you eligible? So there's sort of 5 categories in Canada. One is friends and family.
Yeah.
One is what they call close business associates.
Yeah. What is the definition? Obviously, a friends and family. And I know these are probably gray areas on the definition.
No, they're actually very well defined.
Okay.
So it, for example, says what is family actually. There's actually a definition, you look it up.
Okay.
Right? So your third uncle, twice removed, who lives in Taiwan is not family, right? But maybe your second uncle is. So I think there's a very detailed definition. And also what's a friend actually, it's defined. Mm-hmm. Or what's a close business associate, they actually define that. So you might actually read that and say, well, is this guy you just met at a golf course last week, had a beer with, is he actually a close business associate? Yeah, probably not, because he met the guy once. Maybe he's a dentist, but that's it.
Right.
So,
and then I think there's also a criteria of how long you have to know somebody too. I think it's 90 days or something like that as well.
So these are called national instruments, and you can look those up, and they change sometimes.
Do you know offhand the website, give or take, or so if I was Googling it, where would...
Well, one is NI 45106.
You're familiar? NI 45...
National Instrument 45106. One is National Instrument, I think it's 31103.
Yeah.
And they exist for many industries. So let's say you do mining, right? Mm-hmm. There is a difference between proven reserves and proved reserves. That's defined, right? So if you're a mining guy, there's guidelines just for mining companies, right?
Yeah, so just as an F for everyone, I'll link up those links to those instruments and the public documents, so everybody can get a copy.
Yeah, and they differ slightly by province. Now, there's very similar.
Yeah.
And then there's also what's called accredited investors.
Yeah. So I cut you off there earlier. It was family
and friends,
then close and still business associates, and then now we're talking accredited.
Well, then it's actually eligible investors.
Eligible? Okay, what's an eligible typically?
It's usually like a guy with a lower income, I believe it's 70,000, and or net worth of 200,000, something like that. It might have changed last year or so, but look that up. And accredited means income over 200,000 and net worth outside your house of $1 million.
Right.
And so they might even exclude your business practice. So if you're a dentist and you own a house in West Van for $5 million, mortgage free, and you own a dental practice worth $5 million,
you may not have anything.
But you might not be accredited because these are not financial assets. Because the house is not a financial asset and your business is not either. So then you need to be very careful. So the dentist is very wealthy, but he needs $1 million in financial assets, i.e., RSP money or cash, right? So this gives you the biggest door, accredited investors, and there's one above that, which I think what's called. There's another term for that. If you have net worth over $5 million, or if you invest over a certain amount.
Right, and typically that amount is like, isn't it 150?
Or a large amount, exactly.
Yeah.
And again, it differs by province, right? And even if you have these documents, they might say, well, how do you know the guy has worth $1 million? Well, you told me. Well, they might say, well, it's not good enough. Did you actually check his RSP statement? Well, no, I didn't. Well, they might hit you, right? So be careful that as you go out into the world at large, and now we have websites and statements that is now publicly visible by people. And if something goes wrong or someone's pissed off, they might start calling you. Usually nothing happens if everything's well and everyone's happy. Nothing happens because they can't check hundreds of companies every year, right? But something goes belly up. Guess what? They probably start calling. Or some guys really wants to get you because you lost him some money, perhaps. Maybe you lost 20% or 30%, which can happen, obviously, in a downturn of a market. And they're really angry, and you told them I make 10%, and you actually lost 30%. They might phone the security commission, and they might make some stink, and they may or may not phone you, right? And now you better have your ducks in a row and your documents.
So really, would you say and we're going to come back to a couple other things you said earlier, but really it really comes down to just knowing, in the financial planners world. I'm not saying we're financial planners. I'm not saying it by any means. It's the whole know your client. Really, you need to know them. It's all in the application and the qualification and how well do you know them. If you were to stand in front of somebody and say, how well do you know that person? Tell me the story how you know them.
Exactly.
You just need to know them really well.
Correct.
Right?
Correct. But if they want to trick you, they can probably, right? Because maybe you didn't check the RSP statement. Maybe you didn't check the bank account, actually. Although you know the guy is worth millions of dollars.
Yeah.
You've seen his Porsche and you've seen his house, perhaps, right? But maybe you didn't check his bank account, and maybe he's only worth 800,000 in financial assets, and all of a sudden they fine you because the guy is actually not worth $1 million, he's only worth 800, and you have a problem now, and they fine you, and they could pull your license and make your life miserable. So you got to be, I think, really carefully consider that. I mean, so when we did that in about 2005, we used offering memorandums, which again are these very lengthy documents, which covers all the risks, and it has all these risk acknowledgement forms, and it has subscription documents, and that to put that package together is probably a $25,000 to $35,000.
$25,000 to $35,000. Now, who writes it?
It's a security lawyer. It's a lawyer usually in that province where you raise money. So let's say if you're based in BC, it would be a BC lawyer, securities lawyer. It wouldn't be an Alberta security lawyers, right? Yeah. If you raise money, or if your company is incorporated in Ontario, it's an Ontario lawyer, although you might raise money in BC and Alberta, right? But the documents are slightly different per province, and the lawyers are usually called to the bar, as you know, per province.
So it's a minimum of, you're probably looking at a minimum of $25,000 to $30,000. Probably then when you have to start even factoring in some marketing costs, and you're probably looking at a minimum of $50,000 up front.
Correct.
And there's usually a typical, you need to probably be raising $3 million plus in order to make that feasible. Yeah,
depends on the deal, right? If you do a land development deal with maybe a lot of upside, maybe less than that. If you're not doing an apartment building with skinnier margins, you might want to raise more money, right?
But if you think about it, that offering memorandum document, I would imagine that's the majority. It's front loaded. It's a one-time upfront to get somebody to do it. Then I would imagine for the next ones, it's not a $25,000 touch anymore, right?
No, it's not. But again, I mean, that's how lawyers make money, right? they clone things, right? They don't invent a mortgage document out of thin air.
Yeah.
Right? They always take a boilerplate and amend it.
Yes.
That's how they make money, right? So they give you an OM customized to you, but the OM template was taken from someone else, right? But now they have to go through every clause and make sure that this clause is applicable to you, right? Mm-hmm. Because maybe the mining joint venture is different, has different language than real estate joint venture or the chicken farm joint venture, right? So it's a joint venture on steroids, and therefore, if you can keep it small and stay within your circle of influence, that might be a preferred path, right?
That's what most people, I think a lot of people hear the term raising capital from the public, and it sounds really sexy, right? And that's what a lot of people think, that they need to do that until they actually go through the process. And it's no different than, okay, everybody wants to play in the NHL. Everybody wants to, every kid that ever strapped on skates, I'm Guy Lafleur, sort of show my age, I'm Wayne Gretzky, I want to play in the NHL, until you actually find out what you actually have to do to make it to the NHL.
Absolutely, it's brutal.
I'm okay playing at university level and playing my beer league, and quite frankly, I'm doing very, very well. Doing that too, right? So it is a new game. It's a new sandbox.
And as I mentioned, there's liabilities in that the Security Commission can call you and make your life miserable. Investors can demand lists of other investors. You have to have some reporting mechanism that you would send them some updates, maybe every quarter or at least yearly. Maybe there's a requirement to do audited statements even, which cost a lot more money than if you just do notice to reader or reviewed statements. So you create, and you maybe need now a secretary or part-time paralegal who helps you with all these documents, right? And that there's cost involved in that.
Yeah. So really, there's an entire new level of scrutiny. There's an entire new level of governance.
Correct.
There's an entire new level of transparency. There's an entire new level of your operating, the skill of it as an operator that you have to now factor in. And I'm not saying it, guys, we're not here to freak you out. We're not, quite frankly, I hope everybody who is part of the Raising Capital Academy gets to the point where you have to go to the public to raise capital, because that means you're doing some pretty big things. But we're being real and being honest about it. And you didn't probably take that decision lightly when you decided to make that leap at that time too, right?
No, I did not. But we immediately hired a security lawyer out of Calgary at the time, and we produced these documents, right? Mm-hmm. And ever since the rules have tightened as well, right? So we followed that. I haven't raised money on a larger scale for 4 or 5 years now. So the last mobile home park deal we did was accredited investors, where we did not use an offering memorandum, just a subscription document with risk acknowledgement forms. So and the LP agreement, I think the cost was maybe something like $6,000 or $7,000. Right?
Okay, so subscription document. So let's. I want to just run this through. So you built your list of investors. You put a note out. We're buying 2 mobile home parks. Where were they? They were both in Alberta. Right. Deals on wheels. And you want to own the land that the trailers sit on top of?
No, not the mobile, not the trailer, the mobile home.
The mobile home, sorry, mobile home. Yes, that's the higher end version. So you sent the thing out to your database of investors. What was the languaging around it? And then what did somebody, after they raised their hand, said, I'm interested in? What did you send them? What was the document you have to send? Just walk me through that a little bit, if you could.
So the initial hook was basically an email with some high-level numbers.
Yes.
High level.
Here's an opportunity.
Here's an opportunity, but already qualifying, because part of your marketing, let's call this, is also to qualify the potential customer.
That's right? Marketing. That's all marketing is qualification.
Because you don't have time to follow up with 2,000 people. You want only 20 guys to raise their hand or 30, and ideally all of them invest immediately. Yes. Right? Ideally, you don't get 100 calls and only 1/3 invest actually. And we developed a very detailed pro forma over about 2 or 3 pages with, in our opinion, realistic assumptions about the world at large and rental increases and vacancies and expenses. And usually we do what's called an MTO, minimum target outrageous. And say, well, if the market goes up 2%, that's sort of minimum. If the market goes up 4%, or if the market goes up 6%, and of course, if you do that for 5 years, you get different return targets, right? So we show them, well, it could be here, or it could be here, or it could be here, right? And we give them some box usually, because we don't know what the world will look like in 5 years. You make some assumptions. So we had a fairly detailed pro forma, and with that, you always have to have pictures. Yeah. And here's what it looks like. Where's Eckville? Where's Rocky Mountain House? People don't know that unless you live in the area.
So essentially,
why Alberta? What's our take on interest rates? Like, who are we? There was another partner, Mike Hammerland, involved. Who is he? What's our expertise? What's the property manager? There's a little mini bios with a picture.
Yep.
So it was probably a 10, 12-page document.
Okay, a very robust, essentially a business plan in essence. Yeah.
And then people look at that and say, yeah, I'm interested, and I got $100,000 to invest. Then we would send them the legal descriptions, the physical documents.
So what are those documents? And I'm not saying line by line.
So the legal structure, again, first of all, you have to decide what is the legal structure which actually owns the asset. Right? Okay. There's the physical asset you buy, but the physical asset always sits within a legal environment. Okay, right? It could be you personally own it. It could be a corporation owns it, or it could be a trust owning it. It could be a limited partnership owning it. Okay. Right? So you got to describe first of all, the physical asset you're buying in some depth, but also like what's an LP, for example. Right? You do maybe a little blurb of what's a limited partnership. Not everyone knows that. And then you have a limited partnership agreement, which is, let me say, 8-10 pages. Mm-hmm. And in that you show what are the fees we are taking, because we're not, we're good Christian caring capitalists. We want to make some money too, right?
C cubed. Yeah.
There's an upfront acquisition cost. There is a profit sharing split. Mm-hmm. Right, there's ongoing annual management fees. That's all laid out in the
transparency
in the agreement, which is also reflected in the pro forma. We have the same fees in the pro forma, hopefully. So if I say 2% acquisition cost, but I use only 0.5% in my pro forma, well, then of course the numbers don't match. Right, they got to be the documents have to match. And with that, you have what's called a subscription document, because you are subscribing, in this case, to the limited partnership at a certain price per unit. It might be $1,000 a unit or $10,000 a unit, or whatever the document describes. And you say, I want 10 units at $10,000 a unit. And then you fill it out. And then who are you? I'm accredited. Here's my address. Here's my insurance number.
And then they have to check a box of where they would fit in on their assets, their net worth, their income.
Yeah, and the lawyer prepares that. And that, again, changes by province and might even change every year depending on the...
So that type of a package, you say, is about $5,000-$6,000.
Something like that. Yeah.
So that'd be something that's, and it's not any run-of-the-mill lawyer that can prepare that. It has to be someone who's informed of security.
It's a security lawyer.
Security lawyer. So they would prepare those documents. You include that in there. So you essentially filter out the people who are interested, people that raise their hand. They have to qualify. Essentially, you make an application. They fill out the simplified package after reviewing a very detailed business plan from you, and you'd be quite well protected from any securities regulations based upon the exemptions that you're going through.
And we did also, I think we did one, maybe two telemarketing, like a webinar.
Yeah.
So we essentially walk people through that pro forma. Right? So I mean, with what's called GoToWebinar, you can do a 30-minute, 45-minute presentation where we essentially tell them what you just send them anyway, right? Yeah. But some people just want to hear it from you, and you say, see on page 5, here's the number, and maybe you circle it, and then they say, oh yeah, I didn't see that, And some people just like to hear your voice, and then they can ask questions,
Right. So you've taken the time to go and get these documents and everything, kind of just to protect yourself and your investors. What are you seeing out there in the marketplace right now about, do you see that the way some people are raising capital is actually a little dangerous? Or what are you seeing some people going about doing this out there in the marketplace right now?
Well, I mean, because I'm also an investor now, I'm not just a syndicator. In fact, I probably do less syndications today than I did, 4 or 5 years ago.
So you're saying if I had an opopportunity, I can come to you and talk to you about a really good opportunity?
Absolutely. Absolutely.
So guys, in the business, that's asking for an order. That's
Absolutely. And because I know how to analyze deals, because I do my own deals, right? But I like the idea of not being the active guy all the time. Yeah. Right? I also like to be the passive guy, and just here's a check of 50,000 or 100,000 or 20,000, and you because maybe you're the Thomas expert, or you're the office park expert, because I'm not an office guy, but I think certainly can make money in office or in
Now I'm going to ask a little bit of a side question. Being the active person or the passive person in the investment, which do you prefer better?
Do you like steak or fish?
Yeah, I guess it depends on the mood of
well, one is more work. I mean, obviously, if you are the active person, that is certainly upfront a lot of work, right? To get this mobile home park package under contract was almost a 1-year process, because there was many amendments. We almost lost the deal. We found some environmental contamination. We had to go back and say, well, who's paying for that? We had to drill test holes. for phase 2. And then, as an example, the drill showed up to drill a hole, and as he was erecting his drill bit, he realized, oh, there's overhead wires, so I can't come. He packed his gear and went back to Edmonton. So it was a 2-week delay just to get another drill hole out, and then I come back and say, oh, this is actually not your property, it's the city's property, so I can't drill here. So there's all these kind of little things which happen behind the scenes we don't often tell investors, but until you actually have a deal and a contract, and you know at this price it actually makes sense, because if you buy something where there's potential environmental contamination, you want to have that deal conditional until you know one way or the other. And it's okay to buy if it's dirty, but you need to know what is the magnitude of the problem. If I can remedy this oil contamination for $100,000, that's fine. But I need to know that, right, before I actually sign on a deal, right? So we spent many, many months, probably from summer of 2016 to probably spring 2017.
So you earned your fee.
Just due diligence, right? And go to the site several times. And we actually ended up buying 3 parks because we had to buy them in a package. We ended up selling one after a few weeks just to get out because we didn't want to own that. Park was too small. So there's a lot of things behind the scenes, and therefore asking, let's say, a 2% due diligence fee, which was like, I don't know, $60,000 maybe. Maybe, I'm not sure what it was.
Didn't even cover your hard costs.
Yeah, so I mean, again, and then you look at the deal overall, and some deals are more upfront heavy, and some are more, back end heavy. So that's really up to you to decide.
All right, guys. So we're back again. We just burned through a battery here. So Thomas is dropping just way too much wisdom and knowledge here for us. So we're going to wrap up this thread of conversation, and I have a couple more questions I want to end off with here. So, you were sharing about the mobile home park that you had and all the work and diligence you had, and you talked about the fees and how you get paid and all that kind of stuff. Just for rough structuring, how do you typically structure yours? Do you have acquisition fees, disposition fee, administration fees, and then percentage ownership splits? Like everybody, whenever I ask the question is what's the biggest question people want to know? They want to know, how do I structure this thing? Even though they've never talked to an investor or they have no investors, everybody wants to know how to structure it. So maybe if you'd like to just share how you structure your offerings.
Well, first of all, I think you don't start with limited partnerships and raising $2 million right off the get-go. You usually start on a smaller deal and work your way up, right? So you would do an LP where you raise $2, $3, $4, $10 million perhaps. After you've done a number of smaller deals, maybe for $500,000 or $200,000 or $85,000. And presumably you have some expertise in that space, be it mobile home parks or apartment buildings or office towers or marinas, right? I mean, there's many, many aspects to real estate which all can be really profitable or can all be screwed up, right? Just because you buy multifamily doesn't mean you're going to make money, right? Mm-hmm. You actually have to have some expertise in that space.
Yeah.
And you often have more than one person involved because maybe one person excels at the operations and the other person excels perhaps at the acquisition, and the third person perhaps excels at money raising, because they're all different skills, right? So that's the 3 areas we focus on, or used to focus on, that we had one person primarily on the fundraising side. I would be the assist on that. Mm-hmm. I was initially the acquisition guy, but later we had Mike who was focusing on acquisition. I would be on assist. And then we have a property management company now, which also manages most of our buildings, right, unless they are in remote areas, maybe like Dallas. We had a firm locally, right? Or if you bought something in Vancouver Island, I would hire a local firm probably in Vancouver Island. So you got to have your expertise areas covered.
Yes.
And all these experts or people have to make some money, right? So the fundraiser...
And profit's not a 4-letter word.
No, it's not, absolutely. But the fundraiser, who is very active up front, is usually compensated up front, right? Might get a bit of an equity trailer at the end, but he's on the phone for 6 months to raise the money, and then he's more or less not involved anymore. Maybe with investor relationships, maybe the annual AGM, or maybe in the annual update, he has a little blurb. But he's now on to the next deal probably, right? So that person gets paid usually a portion of your acquisition fee, maybe as much as 50%, or there is a sales commission even, depending on how you structure the deal.
Right.
Or you might take 25% or 33% of the equity overall. Mm-hmm. But it's usually much more front-loaded.
Right.
Similar with the acquisition guy, if that's the only role, that person might get only paid up front. And then you have operations. There's usually a smallish asset management fee. In our case, it's usually about 0.5% of the asset value. Sometimes it's a percentage of rent, maybe 2 or 3% of the rent. Because what you will find, even on a small scale, there is often very little cash flow in the beginning, right? So sometimes you got to over-raise money because you're short upfront usually, right? And the first 2-3 years is tight. You usually do the most improvements upfront, and there's not enough left over to pay management fees. So if you want to pay a management fee, you got to raise that.
Right. So if you needed, in your numbers, you needed 1.8, you might raise 2.
Right. Exactly.
Okay.
And there's what's often called a waterfall model, which is basically, it's called a waterfall.
A waterfall, okay.
Which means, how does the money come back in steps to investors?
Yes.
And it's usually something like that. Once you, let's say, sell the building, all the money that the investors invested goes back to investor. So it's a 0-100 split. I get nothing until the investor gets their 100% money back.
So they have to get their money back first, okay.
That's the first waterfall over the cliff, right? 0-100.
Yeah.
After that, you might say it's 20-80 or it's 30-70 or 60-40.
Okay.
Up to, let's pick a number, 12% a year.
Okay.
So if you are able to deliver 8% overall, well, then it's a 60-40 split, right?
Okay. So,
but if you're able to generate 23% overall, well, only up to the first 12 is a 60-40, and then maybe it's 50-50, or even lopsided in your favor, 80-20, once you're above 15%.
Yeah.
So you got these kind of waterfall models, because often you don't know what the return is.
Yeah.
You might have a real home run. It might not make sense to pay 80% to investors because you leave way too much money on the table for you.
Right.
So if they're happy with a 15% return, let's say, but you're able to generate 25%, which can happen in development deals, then why not take that 10% and pay 15% to investors, right?
Okay. So does the lawyer that's putting this together, imagine in part of the whole process of you putting that document together, the subscription document and clarification, the lawyer be asking you these questions on how do you want to do the splits and things like that. And there's probably no hard and fast rule, is there? It's a little bit of an art and a science.
Lawyers are usually not business-minded people. So if you I take an 8% fee, you said, sure, I'll put 8% in. It might have
to be able to sell it though, too,
it might be totally crappy, it might be totally lopsided. You essentially kill the entire deal. But if you say 8, the lawyer says, sure, I'll put 8 in, because he just puts a number in and he's not usually involved in a pro forma, unless he's been doing many syndications. I think he wouldn't know whether $120,000 a door for a multifamily building in Eben is a good value or not.
Right. So
the lawyer wouldn't know that.
Their expertise is just putting the paperwork together, what you give them instructions to do.
Correct. And of course you can, and that's why I often don't invest in certain deals, because they're so lopsided towards the syndicator. They take all the fees up front. They take a lot of huge management fees, and the entire risk is on the on the investor. One of the
principles you've shared, I'm not sure if it's in your book or not, but it actually has to be sellable. You have to be able to sell it to somebody. It has to be in favor for the investor first. At the end of the day, the investor and the consumer will always vote with their money, always. Right. And if you have a crappy deal and too much in your favor, you get no one to subscribe to it.
Sure, but there's maybe two famous syndications which both went out of business or severely damaged the last few years. One is Walton, very large land developer, have raised hundreds of millions of dollars and very, very good marketing. And they went into receivership, I think 2 years ago or something, 3 years ago now. And one was Fortress in Toronto with many mortgage syndications. And they were able to raise a lot of money because they had a very powerful track record in the past. Yeah. And had very good marketing teams and very high commissions. Right. So just because it is sellable or it is sold actually doesn't mean it's a good deal, right? And again, sometimes you don't know because the market obviously turned in Alberta for 3 years, which I think that ended Walton in this case, because they had so many land deals, which in the end the value dropped from here to here. And if you raise this much money and the value goes from here to here, well then you lose money and you have to still pay fees and property taxes. And guess what? So I don't know what investors lost everything or a portion. We don't know, right? So it has to be sellable, and that's why we put these pro formas together, where you put all the fees in, and you put reasonable assumptions in there, right? Yes. I mean, if you assume the world will go to 18% interest rates, if that's your assumption, well, guess what? Prices will be lower in 5 years, a lot lower. If that's your assumption, right? And then you can raise money because why would I buy a building for $100,000 a door if it's worth $50,000 a door in 5 years, right? So your assumptions need to be realistic, obviously, right? Yes. But then you build a story around it, and the story has to be like a car brochure. It has to be sexy, and there has to be pictures, and it has to be glossy, you know. But it needs to be factual.
Yeah, you have to, you sell the sizzle on the steak, but you also have to have a good steak.
Absolutely.
Right?
Yeah.
It doesn't matter how bad if the cut of meat is bad.
That's right.
It doesn't matter how well you package it.
Exactly. I mean, as I mentioned, I worked for IBM for 8 years, and they really had a superb sales team.
Yeah.
But they also had good products, right? So if you have a good product, well, look at Apple as one example, or BMWs. I mean, they all have good products, but they also sold well. They have, marketing brochures and TV commercials, and there's road shows and car shows. I mean, they spend a lot of money in marketing, right?
Nice, but you have to. At the end of the day, you have to deliver upon what you promise.
Yeah, but the product has to be decent too, right? Yeah. And sometimes you don't have a good product because some markets are on a downturn, and maybe it has run its course, and maybe that product you're trying to sell, doesn't sell well. So that's why we have not done multifamily deals the last probably 3 or 4 years. Yeah, certainly in Alberta, the story was not well told.
Yeah,
wasn't a great story.
Deferred maintenance, and people are still wanting pretty high price for what the financials are saying. It's, I'm not saying it isn't a good investment opportunity. I know some people that are picking up some good properties.
Well, I think now it is, but now being 2018, now it is. But maybe in 2014 or 2015, 2016, it was not, right?
Very good. Well, we're going to wrap it up here. I do have, honestly, Thomas, first and foremost, I just want to thank you. The amount of time you put into this is just phenomenal, and the amount of effort and sharing of your wisdom is just, I'm from the bottom of my heart, I'm grateful. First and foremost, as a friend and somebody who anytime I've ever asked a question to, you've always have been just so generous and grateful with all your time and wisdom. And it's just, and I'm honored to be able to share you with a whole bunch of other people now. Before we do ask the last two questions, why don't you just, into the camera over here, let people know where they can get a hold of you, maybe a website. So I know you're working on some projects yourself right now, always. And you also heard that, you're entertaining people's projects too, if anyone has something on the go too. So let people know where they can get a hold of you.
My one of the emails, which is sort of the one I use in this book, is called Thomas Beyer 808080 at gmail.com. Yeah. So that's an email. You can get a hold of me. You can phone me. Our main website is prestprop.com, Prestigious Properties. And there's links and buttons you can click. It's sort of there's some history as well. I'm doing a development deal right now in Oliver. Mm-hmm. And we might do a syndication or investors in that space, but I want to do it first with my own money and see where it goes. And right now there's some hair on the deal, and I need to learn. So usually what I do is I don't want to syndicate something I have no idea about, right?
And when I share often my story about how my journey to learn how to raise capital, and one of the key principles I learned from is follow the people that were raising capital. And you were one of the people that I followed. If you want to learn how to do something, find people who are doing it. Right. And so I would go through, and we had early conversations, and I was clear from the beginning, Thomas, I'm not going to be an investor, but I want to know how you qualify people. What do you do? What do you put them through? What's your newsletter? I followed all your writings, and you're very well. When you write something, it's not articulate. Is it articulate when you write something? Articulate is speaking.
Concise. I don't know.
But just the way you write is just makes sense. Succinct. Whew, that was a tough word. And so I just followed everything you were doing, and it just made sense. And I think a lot of people, if you actually dive into the world of Thomas Beyer, you will find out that it's just the calls that you've made and some of the predictions that you've done and just some of your worldly insights are just spot on. So I just wanted to give credit where credit is due.
Thank you. No, of course we made mistakes too, right? Because we could have invested more in the US and was booming, and maybe less in Alberta. But I think one question you have to ask yourself always: would I invest my own money in this deal under these terms I'm offering to others?
Yes.
And if you say, no, I wouldn't, then you should stop. that's why we stopped raising money, because my son asked me, should I put some money in your deal? And I said, Alberta was about to turn, right? It was 2014. I knew there was a peak. I said, no, don't. The market is turning, so don't put money in. And sure enough, the market did go down, right?
Right.
So I figured if I can't recommend this investment to my son, who's a doctor now, then I shouldn't ask other people to invest, and we stopped fundraising, right?
So
I've told him since,
eating your own cooking, right?
As it turned out, his wife's parents invested in the mobile home park deal because they actually live in Rocky Mountain House.
Right.
Because at that time it was a good deal actually, right?
And based upon the market conditions, and you analyzed it yourself, and that's the criteria you have, is would you feel comfortable recommending it to your family?
Exactly, with your own money or people close to you, right?
Yep. Very good. So speaking of that, that's actually what a great segue. That leads into my last conversation threads. One is, what are some of the advice you'd offer people? What are some of the big mistakes that you see people making, and what advice would you offer people, whether they're just getting started, they've accomplished, or maybe they're ready to become the next Thomas Beyer out there? What advice would you give them, or based on some mistakes you've made?
Well, we got only a few minutes, so that's why I tried to pen this book and put stuff together. But I think some people are overly eager to syndicate right away and find other people. Right?
Yes.
I think it's really useful to invest your own money first and learn whatever sphere you decide to enter. Yes. Maybe it's townhouses in Edmonton, or maybe it's small office buildings in Victoria, or it's mobile home parks in rural Saskatchewan, whatever it is. Build an expertise in that space and do 1 or 2 or 3 deals so you actually have a story to tell. So look, I bought this mobile home park for $35,000 a pad, and now it's worth $45,000 a pad, and here's my cash flow, here's my numbers. Mm-hmm. You actually can tell a credible story.
Yep.
And that's very believable, and then people will say, sure, on your next deal, let me know, right?
So
I think you got to really build an expertise first, and that takes some time, right? Mm-hmm. I don't know if you travel to Europe, there's a very in-depth baking and cookie and sweets and cake culture, right?
Yep.
Far more in depth than here. You go to an average bakery, there's like 100 different cookies and they all look beautiful. I mean, to produce this kind of quality, it takes many, many years to learn, right? Similar in investments, because you bought one townhouse and got lucky 6 months later, you start, now I'm going to buy 10 more townhouses with money. Maybe you just got lucky once, right? Yeah. And that happens. I mean, if you do deals consistently, you do get lucky once in a while, right? But you can't build an investment story on the one deal where you get lucky.
Right. So, and to use that analogy of a baker, as well as you also can't turn the temperature on the oven up to 700 degrees and cut the cooking time in half either.
That's right. Yeah.
Right. There is a recipe. There is just time that it takes. It takes the time that it takes.
Correct. And therefore, and sometimes, and especially in the beginning, the cash flow is really tight.
Yeah.
So you better have some other income. Don't assume that because the cash flow on the pro forma says $1,500 a month positive cash flow, that this is actually money you can stick in your jeans and live off.
Yeah.
Because often that money goes back in the building in terms of upgrades and new boilers and new bathtubs and new paint and new door handles. And the building will be worth more money in 5 years, but all that cash flow went back in the building and you took out zero yourself. And you can't live on that. You can't live on equity alone. You got to have some other income somewhere, right?
Yes, that's honest to goodness, that's another conversation. The whole game versus actual spendable income versus upside appreciation and equity gains and things like that. I think real estate is the most phenomenal place to hold your wealth. When it comes down to actually, as a business, it's actually, if you really think about it, it's not one of the greatest businesses that generate income out there.
No, but I use this sort of bathtub model because you have a bathtub with water in it, and there's a spout coming out, and that's the money you need every month, right? Ideally, you have multiple buckets of various sizes putting water into the bathtub.
Yes.
And sometimes maybe it takes 5 years, and all of a sudden a big bucket shows up, and lots of stuff goes in, and then nothing for 5 years or for 3 years. Right. And then 2 smaller buckets come in, right? And maybe you have 2 or 3 other little spouts which put water in the bathtub, right? So that's sort of the bathtub model I think of my own cash flow needs, that I need money every month coming out, but as long as there's enough buckets filling the bathtub, And it's not pressure to come out.
Yeah,
you're okay. So
if your only model is just living off the cash flow off of, a portfolio of 5 or 6 rental houses, that's not enough. That's not enough buckets coming in.
Correct, it's not, right? And there's always surprises. I mean, there's vacancies, that's part of the game. There's always some dumb tenants who there's fires, there's, stupid stuff. Like, the sign, "Thou shalt not piss in the elevator," it's rather obvious, but people still do that,
They forgot the word "not" in there.
and you got to clean that up, and there's damage to the cables and crap. Like, people just do stupid stuff sometimes, right?
Yeah. So, what would be if you were to leave our audience here? Last question, I promise. Maybe one final word of wisdom from Thomas Beyer, from the 81st lesson, the unwritten chapter of the book. So, guys, I'm going to hold this up one more time. Make sure you pick up this book. It's on my bookshelf, and I refer to it all the time as well. What would be one more chapter you would add to that as some inspiration for everyone watching?
Well, I still think it's important that you take action, right? And you cannot be perfect. So once you have acquired some knowledge, in the sphere you want to operate in the city you live, perhaps, because it's a decent city and maybe there's upside, just do it, right? Mm-hmm. And yes, you won't be perfect, and yes, maybe you pay too much, and maybe you're not the perfect manager, but as you do it, you learn a ton, right? Mm-hmm. And the next deal you're doing, you get a lot better. Your offers will be sharper, quicker. Your operating expenses will be tighter. You build a bigger network of realtors and property managers and painters and plumbers and investors, right? So I think the trick is to just keep doing, right? And there will be setbacks, like we had in Alberta for 3 years, and it's tough, right? So you have some reserves, hopefully, and live with these reserves, and then keep on going.
Of doing the work every day and learning from everything you've done and mistakes that you've made, lo and behold, 20 years later, become an overnight success.
That's right. Well, as we like to see today, today is kind of a cloudy day, but guess what? The sun is still shining behind the clouds.
Yeah, it is. And you're going to go downstairs and get on your electric bike and go for a tour around this beautiful place that you've lived, and you've earned everything that you have come your way. And the reason why you've earned that, Thomas, is because of your genuineness, your authenticness, and your willingness to share. So on behalf of everyone, I just want to thank you. Thank you for your time.
Happy to share.
Thank you for all your wisdom.
Thanks for your time.
Russell Westcott, I look forward to catching up with you on the next interview. Okay, bye for now.
Thank you, guys.
I sure hope you enjoyed this in-depth training video, and I applaud you for sticking around right to the very end. I believe in people that show up, put in the work, put in the time, and effort should be rewarded. If you're interested in taking the next step, if you're interested in going deeper and mastering what you just learned about in this training video, I encourage you to check out the Raising Capital Academy. So if you have found that you've received some value from the YouTube channel, or maybe you've listened to a podcast, you're only scratching the surface. That truly is just 1/10 of 1% of all the content and materials that have been created that are waiting for you on the other side. So I encourage you to check out the Raising Capital Academy. There's more than 100+ hours of video content, audio content, exclusive training material for those that are interested in taking the next step, those that are interested in going towards mastery, those that are interested in moving forward with velocity. So I would encourage you, wherever you're watching this video, around this video will be a link where you can check out all the details of the Raising Capital Academy. After you've checked out all the details on that page and you're interested in moving forward with velocity, click on the link that will take you towards the application. This is by application only. This is a community program and is for serious action takers only. So if you want to step up your game, if you have goals and dreams and aspirations for more, if you'd like to make a difference in the financial futures of the most important people in your life, I highly encourage you to check out the Raising Capital Academy. Click on that link and you'll be taken to the next step in the process to see if you qualify to take the next step forward for you. Hope to see you on the other side. Bye for now. If you'd like to continue your journey as a successful real estate investor, only 2 simple next steps from here. Number 1 is please subscribe to get all the latest information and latest videos sent directly to you. And over here is a hand-selected video. A video that's been hand-selected for you to help you keep moving forward with velocity. Thank you very much.